Let's bring in Paul Nolte, the Senior Vice President and Portfolio Manager at Kingsview Asset Management, to find out what's behind the bid. Paul, thanks for coming on and taking the time to join us here this morning. It's always a pleasure. Was it the OPEC comments, the draw on the weekly inventories, or possibly both that's giving crude a lift this week?
Yeah, I think the most recent comments about supply-demand, I think, is really what's driving crude. Comments out of OPEC, Russia's overproducing at this point. They still want to get themselves in line to the production goals that they set for themselves in December. They're above that right now. U.S. production's still pretty good, but the big draw was kind of a surprise to the markets, and I think that's really what put a little bit of a bid underneath the energy market, at least over the short run here.
Paul, do you think that we should continue to focus? Should it remain on the demand side amidst some of the economic concerns, or should we be dialed in on production if we continue to see draws at this point?
Yeah, I think really more the demand side.
That's
really what's driving the market here. Yeah, and it's really around the slowing down of the global economy. We continue to see weaker numbers, especially manufacturing. That were to continue, that we should see weaker demand overall.
Paul, some of the lift, I'd imagine, this week comes from some of the geopolitical tensions, somewhat muted, but Turkey's crude oil production reported at something like 54.932 million barrels per day in December of 2018. Barrels per day, I should say. How much should we be focused on the ongoing geopolitical tensions there? I mean, does the impact from Turkey potentially play out here in price?
I don't think so. If you look at the chart of the crude and you look at the price action, the big reaction we got was the bombing of the oil supplies in Saudi Arabia. That was it. Other than that, a lot of the geopolitical news that you're seeing, you're not getting the reaction you would expect in the energy market. So I think really you want to take a look at the much bigger macro picture of growth, supply, and demand. Some of this, I think, will play out over some time. May create some bottlenecks, but right now the markets aren't looking at it.
Noted. I mean, it kind of makes sense in theory. Syria, Turkey, for the most part, not necessarily at the top of the list in terms of producers.
Right. And, again, we've talked about it in the past. You got to look at the major producers, and guess what? U.S. is number one right now. So we got to keep an eye on our production levels, our export levels, and I think that will drive the prices for crude.
Yeah, let's talk about that, Paul, because the EIA is reporting that the U.S. crude production is holding near record highs, up around 12.6 million for 3 weeks in a row. Many feel U.S. crude production will need to get adjusted downward, and there's some concern that lower rig counts and shale bankruptcies are taking a toll. Paul, not sure if you follow Phil Flynn from 321 Energy. I know he's there with you on the trading floor, but he put it well when he said producers are figuring out that if you're losing money on every barrel, you can't make up for it on volume. I'd imagine both OPEC and U.S. producers would like to see crude back above 60.
I think they do, but again, when you take a look at what are they doing, they're producing a lot at this point.
Yeah.
And so until they rein that in, I mean, it is pure supply and demand. It's one of the more pure markets out there. So if you're producing a ton of it, you're not going to get $60, $70 a barrel unless you curtail some of that production. So that's really what we're going to be looking at. When you look at rig count's been pretty flat at a fairly low level for the last few months, plus or minus a few rigs here and there. But what they've been able to do is make those rigs a lot more productive. So what they're getting out of the ground right now is much better production than even just 5 years ago.
Paul, let's talk about what seems to be a bit of a diesel dilemma. The EIA said that we saw a 2.7 million distillate draw, driving distillate supply, which has it around 12% below the 5-year average. If the consumer's a lagging indicator, distillates, I'm wondering if that's a lagging indicator as well. I mean, again, amidst some of the growth concerns that we're seeing here, are you surprised?
A little bit, because if you look strictly at the domestic economy, the consumer actually is pretty good. But if you do listen to UPS, FedEx, some of the big diesel users, they're noting the slowdown in the economy, and it is impacting their deliveries and usage. We're seeing it from the trucking side in general. They're slower now than they were a year ago. So the demand side has come down a little bit. But again, if you're looking at the consumer is still in pretty good shape here for the U.S., so we're not calling for a recession. but just the slowing of the economy.
Yeah, we'll get some sentiment numbers a little bit later on this morning. Paul, really appreciate you taking the time to join us here on a Friday to talk energy markets here. Traders, that's Paul Nolte, the Senior Vice President and Portfolio Manager at Kingsview Asset Management.